LLC ownership and home financing don't always line up the way people expect. On paper, using an LLC can make sense for liability or tax planning in certain situations, but when it comes to buying a home and financing it, especially with standard residential mortgage programs, that structure comes with important limitations that a lot of buyers do not discover until they are already under contract. By that point, correcting it can be expensive, stressful, or impossible. So instead of relying on partial advice from multiple professionals or each looking at only one piece of the puzzle, let's slow this down and walk through how LLCs actually interact with home financing in 2026. What lenders allow, what they do not, why those rules exist, and how to think through your options before you write an offer or structure a purchase the wrong way. This is not legal advice, it's not tax advice, and it's not a replacement for conversations with your financial or legal advisors. It's meant to help you understand how residential mortgage rules actually work, so when those conversations happen, they're grounded in reality and your expectations match what financing programs will allow. Most home financing problems aren't caused by bad decisions, they're caused by incomplete information at the beginning. Let's dive in. To understand why this gets so confusing, we need to start with where the advice usually comes from. Different professionals are answering different questions, and buyers often assume those answers automatically apply to financing. A financial advisor might be thinking about asset protection. An accountant might be thinking about tax treatment. An attorney might be thinking about liability exposure. All of those considerations matter, but mortgage lenders are thinking about something else entirely. They are thinking about who's legally responsible for repayment, how risk is measured and priced, how the loan will be sold or serviced after closing, and whether the loan fits within national underwriting guidelines. When those perspectives collide without coordination, buyers get mixed messages. Someone says, yes, use an LLC. Someone else says, no problem, lots of people do it. And then the lender says, we can't finance this structure. That disconnect is where deals fall apart. To understand why LLCs are treated differently, you first need to understand how conventional residential mortgages are built. Most conventional home loans are designed for individual borrowers purchasing or refinancing residential property with underwriting based on personal income, credit, and occupancy. These loans are not just created and held by one bank forever, they are structured to meet national eligibility standards so that they can be sold, serviced, or securitized in the broader mortgage market. That market expects that borrower to be a natural person, not a business entity. So why does that matter? Because credit risk is evaluated using personal credit history. Income is verified from personal employment or self-employment. Occupancy rules assume a person lives in the property. Foreclosure and servicing rights are written around individual ownership. An LLC does not fit cleanly into that framework, not because LLCs are bad, but because they are not what these loan programs were built for. This is where lender language starts to matter more than most people realize. When lenders talk about borrower eligibility, they are not being abstract. They're asking a very specific question. Who is legally borrowing the money and taking responsibility for repayment? In standard conventional mortgage programs, that answer is an individual borrower or, in limited cases, a revocable trust tied directly to that individual. An LLC is a separate legal entity. Even if you own 100% of it, even if you control every decision, even if you live in the property, from a legal standpoint, the LLC is not you. And that separation is exactly what creates problems for conventional financing at origination. Once you understand how these loans are structured, the next question is typically, can you buy as an LLC using a conventional loan? For most buyers, the honest answer is no. Standard conventional mortgage programs do not allow a loan to be originated and closed with an LLC listed as the borrower. That means the LLC cannot be the borrower on the note, the LLC cannot be the buyer on the sales contract if conventional financing is required. The loan cannot be underwritten as a conforming residential mortgage with the LLC as the owner at closing. This is not a loophole issue. It's not a lender preference. It is how the programs are structured. If a purchase contract lists an LLC as the buyer, most conventional lenders will not be able to move forward unless that contract is amended to reflect an individual buyer instead. And if that change cannot be made, financing options become far more limited. This no can feel frustrating, so it helps to understand why the rules exist in the first place. First, credit evaluation. LLCs do not have a consumer credit report in the same way individuals do. Conventional underwriting is built around personal credit scoring models. Second, income verification. Residential underwriting expects W-2 income, personal tax returns, or documented self-employment income tied to an individual. An LLC introduces additional complexities that does not fit cleanly into residential guidelines. Third, occupancy rules. Conventional loans distinguish between primary residence, second homes, and investment properties. Those distinctions assume a person, not an entity, occupies the home. Fourth, secondary market requirements. Loans that do not meet eligibility standards may not be sellable or serviceable under standard guidelines, which changes pricing, risk, and availability. From a lender's perspective, allowing LLC borrowers under conventional programs would fundamentally change how risk is evaluated. That is why the rules are consistent nationwide. So what about primary residences and LLCs? This is usually where buyers expect the answer to change, and many get tripped up. They assume that because they plan to live in the home, that LLC structure should not matter. But occupancy intent does not override borrower eligibility. Even if you plan to live in the property full-time, if you're the sole member of the LLC, and if that LLC exists only for this one property, the loan still originates to an entity rather than a person. And for conventional loans, that distinction matters at the point of origination. This is where timing starts to matter. On a separate but closely related question buyers often ask is, can I buy the home as an individual and then transfer the title to my LLC later? In some cases, this answer is yes. Many loan servicing guidelines recognize that ownership structures can change after a loan closes. A transfer of title to an LLC may be permitted after closing if certain conditions are met. Typically, that means the original borrower remains the controlling party, the property continues to be occupied as intended, and the transfer does not trigger a prohibited change under the loan terms. What's important to understand here is why this is allowed. This is a servicing consideration, not an origination strategy. The loan still starts with an individual borrower, the financing still happens in that person's name, and the LLC only comes into the picture later if the servicer allows it. Not every servicer handles this the same way, and documentation or notification may be required. That's why post-closing plans should be confirmed in advance and not assumed after the fact. Just because a transfer may be permitted does not mean it works the way many buyers expect long-term. Some buyers treat post-closing transfers as a workaround. They are not. If you plan to refinance later, change loan programs, or restructure your financing down the road, ownership structure matters again. In many cases, title may need to be returned to an individual ownership before a new loan can be originated. That's because conventional underwriting rules apply at origination, not at servicing. This is why long-term planning matters. Even when LLC ownership is permitted after closing, it can affect future flexibility in ways buyers don't always anticipate. One of the most common mistakes buyers make is listing the LLC as the buyer on the purchase contract without confirming financing rules first. When that happens, the lender may be unable to approve the loan, the contract may need to be rewritten, closing timelines can be delayed, earnest money may be at risk. This is not hypothetical, it happens regularly, especially in competitive markets where buyers rush to submit offers before aligning financing and ownership structures. The simplest fix? Structuring the offer correctly from the beginning. It's often the most overlooked. A lot of online content treats LLC ownership as a universal strategy. That content often blends residential and commercial financing, ignores secondary market rules, assumes cash purchases, or relies on lender-specific portfolio products. Those scenarios may work for some buyers, but they're not representative of standard residential financing. When you see statements like, "People do this all the time," the missing question is, with what type of loan? Because the financing method determines what is possible. LLCs absolutely have a place in real estate ownership. They're commonly used for long-term investment properties, multi-member ownership structures, asset protection strategies, commercial real estate, portfolio or private lending arrangements. In those cases, financing is often non-conforming, held by community banks, structured as commercial or business debt, or completed without traditional residential underwriting. Those options exist, and they can be quite effective. but they are not interchangeable with conventional home loans. Understanding that difference is critical. Problems arise when buyers try to combine residential loan pricing with commercial ownership structures. You typically cannot have both. Residential loans offer lower rates, longer terms, and consumer protections. Commercial or entity-based financing offers structural flexibility, different risk assessments, different pricing and terms. Trying to force one into the other is where deals stall. At this point, some buyers start to feel like lenders are asking too many questions. Questions about title, questions about entities, questions about future plans. It can feel intrusive or overly cautious, but those questions serve a very specific purpose. Lenders are making sure the loan remains compliant for its entire life. That includes how the property is owned, who is responsible for repayment, and whether the loan still fits eligibility rules years down the road. A loan that violates those rules after closing can create serious servicing problems later. That's why lenders press for clarity early. It's about preventing problems that are much harder to fix once the loan is already in place. This conversation gets a lot easier when you change the question you're asking. Instead of starting with, can I put this house in an LLC? Start with, what kind of financing do I actually want to use? And then work forward from there. What are the eligibility rules for that loan? What ownership structures are compatible with those rules? And how much flexibility do I need in the future? When you ask questions in that order, the right structure usually becomes much clearer, and you avoid forcing a strategy that doesn't fit the financing. Here's a simple way to think about this without overcomplicating it. If your priority is a conventional mortgage, consumer level pricing, standard residential underwriting, then the structure that aligns best is usually buying as an individual, writing the contract accordingly, and discussing any post-closing title plans in advance. On the other hand, if your priority is entity ownership at purchase, business level structuring, or more control over ownership and liability, then you should expect different financing options, different terms, and different qualification standards. Neither approach is wrong, they just solve different problems. The mistake is trying to combine pieces of both and expecting them to work together seamlessly. Here's the most important thing to remember. LLCs and home financing are not incompatible, but they're not interchangeable either. Conventional mortgage programs are designed around individual borrowers. LLC ownership introduces a different legal structure that often requires different financing. When buyers understand that distinction early, they avoid delays, denials, and unnecessary stress. Clarity upfront saves time, money, and frustration later. If you're thinking about buying a home and want to understand how ownership structure could affect your financing options, use the link below to book a call with my team. These conversations are most helpful before you write an offer. Early clarity can save you months of frustration later. And if you want clear, reliable explanations about lending rules, financing options, and the numbers that actually shape real home buying decisions, make sure to hit that subscribe button. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you next time.